My name's John, and this is Honest Patina, making money grow and talking ideas. Subscribe to hear more. The entertainment's free. I often talk finance and technology. Are you ready for the quickest options tutorial to get you from euphoric FOMO to in the game? Well, all you YOLO artists, ramblers, gamblers, and day traders, slap that like button because this video is for you. If you get sweaty palms or can't emotionally detach yourself from the money you might lose, I understand because I used to be that way too.
I would ask you if you could remain emotionally detached. But I don't think that's your problem, is it, Bond?
No. The first thing you have to do is determine whether or not you're bullish or bearish on the underlying stock. Bulls buy calls and sell puts. Bears buy puts and sell calls. Advanced traders are able to use trading strategies to define their risk. We can talk about this in a future video. If you're interested, leave a comment below. In this video, we're going to exclusively focus on buying calls and puts because they have the cheapest barrier to entry and they have the most appealing risk to reward ratio. The most you can lose is the value paid for the options premium. The most you can make is unlimited when you buy a call and limited, but still a lot, when you buy a put. Oh my God, did he just say unlimited? Well, it's entirely possible, but unlikely. Now, for all of you out there that have lost interest at this point, I would just stick to buying and holding the underlying stock of your interest because it's about to get a bit more complex. Look, you gotta understand the basics of the following terms if you wanna have some semblance of confidence when trading options. Expiration date. Let's use an analogy. And let's also assume that you're not lactose intolerant or vegan and you're at the store to buy a gallon of milk. You're given two options. You can buy a gallon of milk that expires this Friday or the following Friday. Well, if you can't drink the gallon of milk by this Friday, you want to give yourself more time to enjoy it. So you choose the gallon of milk that expires next Friday and that gives you enough time to finish it. Similar to the milk analogy, options expire every Friday at 4 p.m. Eastern Standard Time. The further you go out, the more time you give the underlying stock an option to trend in the desired direction. The catch is that options become more expensive the further out the expiration is, due to the benefit of having additional time for the underlying stock to trend in the correct direction. The strike price. These are listed in ascending or descending order depending on the trading platform that you're using. If you're bullish, implying that the value of the stock is going to increase, you would choose a strike price that's greater than the current share price. Similarly, if you're bearish, implying that you believe that the value of the stock is going to decrease, you would also buy a strike price that is greater than the current share price. Premium. It's the cost of the options contract. The contract gives you the right to buy or sell 100 shares of the underlying stock. We love premium. And we don't like to exercise the options contract. You can see here in the Robinhood platform, the premium is listed on the far right hand side. Side note, you can't exercise something that you don't have. So let's say you bought a put, for example, and you try to exercise the put before or on the expiration date. Well, if you don't have 100 shares of the underlying stock, then you can't exercise. Similarly, if you bought a call, exercising that option would force you to have to buy 100 shares of the underlying stock, and you may not have enough buying power. So let's stick to trading premium and let's not exercise our options contract. Okay, this is the moment you've all been waiting for. Let's say you're bullish and you want to buy a call, which is also synonymous with long call. First thing you have to do is search for the underlying. Let's look for Palantir. First thing we want to do is determine the at-the-money value, which is the equivalent of the current share price, $32.19. Then you want to choose an expiration. You have all of these options. They occur every Friday. Remember, you want to choose an expiration that gives the underlying stock enough time to trend in the direction that you think that it's going to go. Then you have to select a strike price. For a call option, everything above the at-the-money value is called out of the money. Everything below the at-the-money value is called in the money. You should buy whatever you can afford, assuming that it's going to trend up and to the right. By the way, I would avoid trading options at market open. Allow time for the volatility of the trading volume to fall so that you can find the option premium at a deal. Select the premium, hit continue, determine how many contracts you'd like, when you'd like that to expire, whether that's good for the day or good till canceled. If your order doesn't execute today, it'll expire in 90 days. I usually do good till canceled, especially if it's a good deal and it's something that I want. You would review order and submit. But wait, I'm bearish. What do I do? You want to buy a put. Again, you would search for the underlying. Determine the at-the-money value, or the share price, which is $32.19 in this case. Select the desired strike price. For a put, all of the values below the share price are considered out of the money. All of the values above the share price are considered in the money. It's the opposite from buying a call. You would select your premium. Select continue. Determine how many contracts. Determine when it expires, whether that's good for the day or good till canceled. You would review your order and submit. When you're ready to cash out, to present yourself from further loss or claim your gains, you would close the option. You would essentially sell that call or sell that put. If you enjoyed this type of content, consider subscribing, slap that like button, show me some love. Jmart out.